Good afternoon, everyone. Good afternoon, everyone. Welcome. May I have your attention for a few minutes? I know that you're still continuing with your meals, so please continue to do so. But I would like to get the program started. We are very, I'm very pleased, we're very pleased that the President of the Federal Reserve, 9th Federal Reserve District is with us today, Mr. Neel Kashkari. I've had an opportunity to work closely with him on a project, and I have great admiration for the work that he does and the fact that he's a very outspoken person as it relates to Fed policy, and he's very frank, and it's honored for me to get to know you, and also to have you as a part of our NACD FEI event today. As you are aware that all of Mr. Kashkari's remarks are recorded and live streamed, and at the end of this program we will provide a link to you so that you'll be able to watch them again. We want to thank the Federal Reserve Bank of Minneapolis for this opportunity to be with us today. At your table, both gentlemen have lengthy bios. I won't run through those again. We'll spend some time, more time with Mr. Kashkari's remarks, as well as Dr. Banyan will spend time in moderating after. As you know, again, Mr. Kashkari took office as President and Chief Executive Officer of the Federal Reserve Bank, 9th District, on January 2016. Dr. King Banyan is, I was told I'm not supposed to say an old friend. He's a longtime friend here, and I'm glad that we have an opportunity to do that. He's Dean of the School of Public Affairs at St. Cloud State University. He's also professor of Department of Economics at the university and holds a PhD. So without further ado, I'd like to please give a warm welcome to Mr. Neel Kashkari.
So thank you, Mike. Really appreciate your invitation to be here. I'm going to speak for just a few minutes about the Federal Reserve, the work that we do, and then King and I will come up and have a conversation, and then we're going to turn it over to all of you to hear from you, and hopefully you'll ask questions and give feedback and comments. And I usually tell audiences to do me a favor, because if you have a question, there's a good chance somebody else has the same question, and I would much rather have the opportunity to try to address the question than have you be too quiet and respectful and walk away wondering what the answer is. So please don't be shy. Let me just spend a couple minutes. You probably know this, but I always like to level set and talk about what the Federal Reserve is, what the Minneapolis Fed is, and what we're focused on. That's usually good background for the work that we're doing right now. So the Federal Reserve is obviously our nation's central bank. It was created by Congress in 1913. It was the third attempt to create a central bank in the United States. The first attempt was by Alexander Hamilton, the first bank of the United States. It lasted about 20 years, then they got rid of it. Then there was a second bank in the United States. Lasted about 20 years, then they got rid of it. They kept getting rid of the central banks because the whole idea of having a central bank at all sounded very undemocratic. A bunch of bankers in a dark room making these mysterious decisions. Who needs it? Well, then something happened. In the late 1800s, the US economy was hammered with banking crises. And especially in the ag sector, farmers couldn't get credit. And there was a big crisis, the banking panic of 1907. And then Congress said, well, even though we don't like it, I guess we need to have a central bank. But let's do something. Let's take a feature of the US Constitution and let's build checks and balances into the central bank. So in 1913, Congress created the Federal Reserve System, which includes the Board of Governors in Washington, D.C. There are 7 members of the board, including the chairman, who's currently Jerome Powell, appointed by the President of the United States, and then 12 independent regional Federal Reserve banks, including the 9th Federal Reserve Bank, the Minneapolis Fed. And that was Congress's idea to say, let's get some of the power out of Washington, D.C., and let's distribute it around the country so the regions of the country are directly represented in policymaking. And very importantly, while the Board of Governors are all appointed by the President and confirmed by the Senate, The presidents of the 12 Federal Reserve banks are appointed by a local board of directors, and we are not appointed by the president. We serve at the pleasure of our local board of directors. And in fact, one of our directors is Kate Kelly, who's been a long-serving director and done a great job for the Minneapolis Fed. Thank you, Kate. She's here today. So these checks and balances are fundamental to the work of the Federal Reserve. And the reason that there's a Minneapolis Fed is we are literally here. We literally exist to represent all of you in the nation's monetary policy and central bank work. So a lot of my time in our region is Minnesota, North and South Dakota, Montana, the Upper Peninsula of Michigan, and northwestern Wisconsin. A lot of my time is spent traveling around our region, doing forums just like this, where I get to hear from constituents, business owners, workers, nonprofits, to hear directly how is the economy going. And then every 6 weeks, I go back to Washington, D.C., and participate in FOMC meetings, Federal Open Market Committee meetings. And part of what I'm doing in those meetings is talking about what's happening in our regional economy. So getting invited to events like this are a wonderful opportunity to not only share with you what we're doing, but more importantly, hear from you how are things going. So that's the background. Now, what's going on in the economy? What are we focused on right now? Since I've been at the Minneapolis Fed for about 3.5 years, I have been quite consistent in arguing against interest rate increases. Now, let me tell you why. We talk about a dual mandate. Congress has assigned us 2 goals. One goal is stable prices. Think about an economy that's not overheating, but also not crawling, a steady economy. The other hand is maximum employment. As many Americans who want to work are able to find jobs. Traditionally, we think these 2 goals are linked through wages. So as the economy heats up and the unemployment rate falls, businesses struggle to find workers, then they have to start paying more to keep their talent or to find new talent. Eventually, they have to pass those costs on to their consumers. So it's like a seesaw. The labor market gets really tight. Ultimately, we think that leads to inflation, and we're trying to balance these 2 goals. Well, for the last 3.5 years since I've been at the Minneapolis Fed, I've looked at the data and I've asked the question, is the US economy really at risk of overheating? Yes, the unemployment rate has been falling, but wage growth is only picking up a little bit. It doesn't seem like we're really at maximum employment. Inflation keeps running below our 2% target, so why are we tapping the brakes? So I've been an outlier, and by the way, the vote in the FOMC is a vote. So if you are a lonely voice, guess what? The vote doesn't go your direction. And that's the way the democratic process works. So I've been a lonely voice saying, I don't see evidence the US economy is overheating. In the last 6 to 9 months, more of the committee has moved in this direction because some of the downside risks have increased. So what I hear a lot from businesses is that the tariffs and the trade war are really concerning businesses, really giving a lot of uncertainty to the outlook. So we're seeing business investment pulling back. That's leading to nervousness. So now it appears my initial thesis that I don't see evidence that the labor market is really that tight or is overheating, I think that's still true. And at the same time, now we're seeing greater downside risks in the global economy, especially related to trade and to tariffs. And it's not just hitting the US, it's hitting Europe, it's hitting Asia, and all of our economies are linked. So even if the US economy is strong based on its own fundamentals, its own domestic fundamentals, if the rest of the global economy slows down, that will end up slowing down the US economy too. And so I think these 2 factors are now working in the same direction. Arguably still slack in the labor market, US economy is not overheating, wages are only picking up slowly, and now we have these broader downside risks. So to me, that's my explanation of why the Federal Open Market Committee voted to cut interest rates in July. And I think, until we see inflation, I don't actually think we should tap the brakes in the economy. Now, let me say one other thing, then I'm going to turn it over to King, and we'll have a conversation. It's very, very hard for economists to forecast recessions. If we could forecast it, we would take action to prevent it, okay? The fact that we can't forecast it is why we always end up being surprised. The single best predictor that anybody has found of recessions is this thing called the yield curve, which is if you plot US government bonds, the yield on bonds by their term, a 1-year bond, a 2-year bond, a 5-year bond, a 10-year bond, a 30-year bond, typically the curve slopes up. So if you buy a bond from the US government, you are making a loan to the US government. If you buy a 10-year bond, you're making a 10-year loan to the US government. If you buy a 30-year bond, you're making a 30-year loan to the US government. Typically, if you tie up your money for longer, you want a higher return. If you're going to tie it up for 1 year, you typically want a lower return than if you're going to tie it up for 10 years or for 30 years. So it usually slopes up. But once in a while, it flips. And short-term government bonds have a higher yield than long-term government bonds. And basically, every time that's happened in the past 40 or 50 years, a recession is followed in the next year or two. Well, that's happening now. And it's a concerning sign because it means that investors in bonds are nervous about the future. They're nervous about the growth prospects of the global economy. They're nervous about the growth prospects of the US economy. They don't see evidence that inflation is about to take off or the US economy is overheated. Now, every time this happens in the last few cycles, there are some economists who come out and say, yeah, we've looked at it. This time is different. All right, those are the most dangerous words in economics, just in case you're confused about that. So I don't believe this time is different. I'm certainly not willing to bet the US economy on this time is different. So this is probably the most concerning signal that we're seeing right now. Some people say, no, bond investors are too bearish, they're too pessimistic, but maybe they figured something out that the rest of us haven't. So it's something that I'm paying close attention to. So with that background, King, why don't we come up, we'll have a conversation, and we'll turn it over to the audience.
So thank you, everyone, and good afternoon. Thank you to NACD, to my longtime friend, Mike, and Mike Vekich, and thank you, Neel, for agreeing to be with this group today and for the opportunity to speak together. There will be a microphone going around, I assume, at some point, and we will take your questions. And as you heard President Kashkari say, he needs your feedback in order to be able to do his job best. But when he takes those views over to FOMC, I'm happy to say that occasionally in the Beige Book, which is a report on economic conditions in the various districts, things that we write up in St. Cloud end up in those notes. And so it's always a moment of pride for us in St. Cloud when we see that happen. So thank you for that opportunity. But first, I want to get to the most important thing. How are you enjoying life as a new father?
So my wife and I had our child in February, our first baby girl, and it's terrific. It's all it's cracked up to be. And we read all the books, and we're not doing any of what the book said. None of them have worked for us. Our baby is sleeping with us, and in the middle of the night, she'll wake me up by flailing over and smacking me in the face, and it couldn't be better. So.
Awesome, awesome. For those of us of a certain age, we miss those days. So one of the things that you would know about President Kashkari is that he was at one time named the $700 billion man. That was when the passage of TARP came, and in TARP he played an integral role. Okay, so perhaps nothing in that $700 billion was more controversial than AIG, right? The sale of which you supervise, as I understand it. I've read your Brookings paper from I think a year or two ago, and I know you still think you did the best you could under the circumstances. How confident are you that we could handle another AIG if one should occur?
Not very. So, I was appointed by President Bush. I was in the Bush administration at the Treasury Department, and I also served under President Obama. We all hated the idea of intervening in markets. We all hated the idea of bailing out the banks. But when the country faced a complete collapse of the financial system, that's when Secretary Paulson and Chairman Bernanke went to Congress and said, we need the authority to bail out the banking sector. Because if we allow the whole financial system to collapse, we could be facing a Great Depression scenario. So it was the right thing to do, and I'm glad that it worked in terms of stabilizing the banking sector. But the recovery has been brutal on the American people. It would have been worse if we'd allowed the banking system to fail. So it was the right thing to do, but we never, ever, ever want to have to do it again. And the single best way to prevent that is to make sure that the banks, the big banks, have enough capital to be able to bear their own losses when they make mistakes. When my wife and I moved to Minneapolis 3.5 years ago, we bought a house, and our bank made us put 20% down on our loan. The more money you put down on your loan, the safer it is for the bank. You put down 50%, it's a very safe loan. 20% is better than 10%. Well, big banks in America today put down about half that amount on their own portfolio than they make us put down. If we made the big banks put down as much, 20% on their own portfolio, that would largely protect the taxpayers from ever having to bail them out again. So I'm not confident that if there's another AIG or a giant bank or another systematic crisis gets into trouble, I think we're going to have to bail them out again. And I'm not happy about that.
So let me...
On that good news.
On that good news. I don't see any questions yet. So let me go to talk about this, and recognizing that we're at an NACD meeting where there are many of you here who are directors on boards. Last month, the CEOs in the Business Roundtable issued a statement regarding corporate the purpose of a corporation, saying the company should no longer advance the interests only of their shareholders. You've been able to observe corporate governance from a variety of positions, both in the public and private sector, from finance to IT. How do you react to the Business Roundtable's new statement?
You know, I think it's basically cheap talk. Let's be honest. You know, first of all, in the Twin Cities, coming here, one of the things that surprised me is how engaged the corporate sector is in the cities. And that's a great thing. It really is a hallmark of the Twin Cities. It's more robust than I've seen it anywhere else that I've lived, and I think that's great. But, you know, there are many CEOs. Applaud yourself, it's true. You know, that's not happy talk. I think it's true. It's a real differentiator for the Twin Cities. But there are many CEOs of the big banks who are actively opposed to forcing them to have enough capital to protect the taxpayers. The reason they do that is the lower their capital levels, the higher their equity returns, the higher their stock price. So if we make big banks have enough capital to protect taxpayers, that's going to be bad for their shareholders. And so the big bank CEOs that are part of the Business Roundtable putting out this lipstick, you know, let's see it when they actually raise their own capital levels to protect taxpayers. That's when it's real. Otherwise, this is just a cheap political gimmick.
I just saw hands go up. Awesome. That did it. Good. I'll tell you what. Do you have
somebody
the microphone
disagree?
up there?
Tell me if I've got it wrong.
If I see if you have the microphone, stand up. Otherwise, I'm not going to be able to see you. But I will while you move the microphone around, I will ask one more question. Many people think of the Fed as a temple for PhD economists. I'm one. You're not, and neither is Chairman Powell. How is the Fed helped by having some non-economists in the room when the FOMC meets?
You know, I was chatting at lunch with King that the FOMC participant that I probably most closely align myself with in terms of our policy views is James Bullard, the president of the St. Louis Fed. We've probably been the two most outspoken advocates for low rates. Our life paths could not be more different. I mean, Jim is a PhD economist who grew up at the Fed, worked his way up, and has been president of the St. Louis Fed for a number of years. So here we have a former aerospace engineer and myself and his PhD economist, the outliers, but seeing things, you know, quite similarly. I think the debate at the FOMC is really enhanced by the fact that we have a diversity of backgrounds and a diversity of views at the table. You know, when I prepare for FOMC meetings, we have a wonderful team of research economists at the Minneapolis Fed. Our research meetings are like intellectual wrestling matches. You know, it's no punches are withheld. We're just attacking each other's ideas, challenging each other, so that by the time I go to Washington, my arguments have been very, very, very well vetted. And I am rarely surprised when I get to the FOMC that there's some argument that I had not heard before. So for me, I think that diversity of views makes it more likely we're going to make better decisions.
Great. So we have a question from the audience.
Hi, I'm Bryce Doty. First of all, as a bond manager, I want to thank you for all your creative and wise judgment during the crisis. I think you did a lot more than people will ever give you credit for, so thank you for that. My question is, what's your take on the impact that a cut in rates would have on the supply chain problems created through tariffs? You know, people are saying it doesn't really solve that problem. Like, the people in this room aren't going to suddenly change their CapEx plans because the tariff issue is still there, even if rates get cut. What are your thoughts?
I think that's true. I think that monetary policy is a poor tool to try to undo the economic harm of a trade war. It's an imperfect tool, but it's the one tool, one of the few tools that we have at the Federal Reserve, and our jobs are to respond to the economy as we find it. So, I'll give you an example. Congress could pass some fiscal package. Maybe it's infrastructure, maybe it's education, maybe it's healthcare. That would have some effect on the U.S. economy. We at the Federal Reserve have to look at how we think the U.S. economy is going to evolve and try to achieve the goals that Congress has given us, stable prices and maximum employment, with the tools that we have. So I'm with you. I think if the trade war really gets a lot worse, monetary policy is going to be very limited in its ability to respond to that. Nonetheless, we have a job to do to the best of our ability given the tools that we have. And so if business continues to be uncertain, if business investment continues to slump, if the recession warning lights continue to flash, I think the Federal Reserve will need to do what we can to try to keep the economy growing.
Before I take the next question from the audience, let me ask to follow up with that. To what extent, I'm seeing more things in the FOMC statements regarding exchange rates and the impact of exchange rates on the economy. What does that conversation look like? Because you just talked about the dual mandate of the Fed. Exchange rates are not in that, but there are other central banks that have an exchange rate mandate. How do you see the exchange rate working in terms of monetary policy and how the FOMC conducts it?
It's an input into our policy deliberation. So we never try to target the US dollar. That's not our jobs. What we do try to do is achieve these two goals that I talked about. And we know, all else being equal, if the US were to raise interest rates and everything else is the same, typically that'll lead to the dollar going up because foreign investors will demand US assets because they can get a better return in America. So typically there's a feedback loop of monetary policy actions, moving exchange rates, feeding back to the US economy. So we have computer simulations that model these feedback loops. If the dollar goes up, if the dollar goes down, if the euro-yen moves, et cetera. So it's an input into our policy process, but it is not something we target. We target trying to achieve maximum employment and stable prices, and that's just something that we have to try to factor into our analysis.
Okay. I think the next question's here in front. You have the microphone?
Yes.
Okay, so the person with the microphone in the back, you're next.
And could you do me a favor and introduce yourself when you ask your question, please?
I'm Tom Camp. I'm an independent director. President Kashkari, thank you for your visit today, but I'd like to remind you that you began your talk asking for difficult questions.
Please.
So here it goes. Last December, the financial markets were under great stress. There was great concern that the economy was slowing, unemployment would begin to tick up. And on December 19th, the Federal Open Markets Commission actually raised interest rates despite President Trump vocally and very aggressively calling for interest rate cuts. 3 weeks later, the FOMC seemed to have been vindicated with a very strong employment report. My question is, did the FOMC raise interest rates in December in order to show its independence, or did it have advanced knowledge of that strong employment report?
We don't have, or suggests either or. I would say neither is the true answer. So first of all, in October, here again, it's a vote. In October, I wrote an op-ed in the Wall Street Journal saying we should not raise rates. We should pause because it's not justified by the data. The committee raised rates in December, and then, as you indicated, began a pivot to a more accommodative posture. I think conditions changed, and I don't think, people ask us about the political environment. If we respond to politics by doing what politicians want, we're not doing our jobs. If we respond to political pressure by doing the opposite, if it's not supported by the data, we are also not doing our jobs. So the best thing we can do is do what's right for the economy. And that's where there's unanimous agreement amongst all the principals at the Federal Reserve, starting with our chairman, Jerome Powell, to do the right thing for the economy, for the goals that Congress has given us. Between December and January, we saw economic conditions change quite dramatically. And I think that is what motivated my colleagues to take a different view of the outlook for monetary policy. And that's when some of the downside risks really started to emerge. And we said, hey, it may not all be upside risks. There may be downside risks. And I think that's what motivated the change, not politics, one way or the other. Thank you.
Question in the back. Here you go. And please introduce yourself.
Douglas Kuplick. And there's been increasing attention over the rural-urban divide that exists in much of the Federal Reserve's largely rural 9th District. As many know, rural and urban areas are becoming more divided among political lines, and as much that's attributed to differences in economic opportunities between those living in larger cities versus rural areas. For example, while Minneapolis and St. Paul prosper with construction cranes and help wanted signs, the main streets infrastructure of rural America are aging, and opportunities for employment are few and far between. Question: does the Federal Reserve have a role in helping narrow the rural-urban divide, and if so, what does it look like to those that make rural America their home?
Thanks for your question. This is a topic that comes up all the time when I travel around our region, and your characterization is exactly right. So let's go to monetary policy for a second. There's one currency for the whole country. So we can't target a different interest rate for the Twin Cities or for rural America or for Texas or for California. It's one monetary policy for the whole nation. So when I make recommendations in Washington, D.C., it is taking a view of the nation as a whole, but informed by what's also happening here locally. So I think the Fed's direct influence on the challenge you raised is limited. We do a lot of research on economic gaps. So we launched in the Minneapolis Fed a couple years ago what we call the Opportunity and Inclusive Growth Institute, specifically looking at why do these gaps exist. There's rural-urban gaps, there are racial gaps, there are socioeconomic gaps. Why do these gaps exist? Why are they so persistent? What are some of the solutions that could help close the gaps? So even if we at the Fed can't implement the solution because we don't have the tool, if we can arm Congress with the information or the State House with the information, then they potentially could implement the solutions. So it's an area of intense research interest to us. One thing that I have observed, some rural communities have done a better job than others of tackling this issue. And I've asked them, how have you done it? They've done it a few ways. Number one, some smaller communities have a better partnership between their local business leaders and their civic leaders, and they work collaboratively. I've seen it successfully. Number two, some of those partnerships really focus on making the local community an attractive place for their young people to come back to. They may go off to college, they may go off and get their first job, but when it comes time to start a family, many of them want to come home. So the local leaders are making the community attractive for them to come home, and some are having success. And then third, some are embracing immigration. You know, immigration has been a huge driver of economic growth throughout America's history. And one source of economic growth is simply population growth. If your population is not growing, or if your population is declining, your economy is not going to grow. Some communities across our region have really embraced immigration, and it is bearing fruit. It's not easy. It's a lot of hard work. It takes a long time. But those that have been at it for a while are seeing their communities continue to grow and continue to thrive. So when I travel around our region, I always tell people, you have three choices. You know, we're having fewer kids than prior generations. So we can either accept slower growth, we can do what Japan is trying to do and subsidize fertility to try to encourage families to have more babies. It's really hard to do, by the way. And it takes 20 years to grow a new worker, just to do the math. Okay. Or number three, you can embrace immigration. That's it. That's math. So I'm not going to offer you a value judgment of which of those three you should pick. I'm just laying out the math. And some communities have embraced immigration, and their communities are still growing, and they're still vibrant.
Great. I think the next question's here.
Thank you. Great to have you here, Neel.
Thank you
for being here. My name's Kim Nelson, and you know, clearly there's quite a bit of talk about recession. And you know, you mentioned the bond yield curve inversion. There's what's going on in the manufacturing sector. There's the trade war, et cetera. My question is, if we go into recession, thinking back to where we were in the last recession, are we better positioned? Are we more resilient at this point in the US and in the global economy, or less so? So I'm thinking of the mortgage crisis and that situation versus where we are now. You mentioned some of the regulation that should be in place that isn't, but what is your assessment of length, duration, not even the specifics, but intensity basis where we are now versus where we were at the last recession?
Thanks for your question. A great question. It's complicated. I'll say we typically have, think of an ordinary recession, 2001, you know, the early 1990s, where the economy retrenches, unemployment goes up, but the recovery is pretty quick. If we have a recession, I hope it's that kind of recession as opposed to the '08 recession where we had a full-blown financial crisis. I think the financial system is stronger than it was in '06. It's not strong enough, but it's stronger than it was in '06. So the odds of us having a full-blown, devastating financial crisis is lower. That's the good news. The bad news is if we have an ordinary recession, the Federal Reserve has less room to cut interest rates to respond to that. Typically, the Federal Reserve in ordinary recessions would cut interest rates by about 5 percentage points. Well, today interest rates are around 2%, so we just don't have as much room to cut. And we'd have to turn to some of our new tools like quantitative easing and other things to try to provide some stimulus. So good news is less likely to have an intense financial crisis. Bad news is if we have a normal recession, we do have on the margin fewer tools than we typically have had. And that's where fiscal policy would probably have to play an important role. Unemployment benefits, some kind of fiscal stimulus, but our political dysfunction right now and our polarization makes a fiscal response less likely.
Do you have a question here? Stand up, please.
There you are. Hi, I'm Dave Longren. I'm an independent director.
Hello.
Thanks for taking the time here. It's really been informative already. A follow-up on that question is, as an inevitable kind of downturn comes at us and interest rates cut, and we don't have a lot of room, you head down towards zero or potentially negative interest rates. What's kind of the implication on some of the business sectors, financial sectors? How do you any sense of how that kind of new territory could play out?
Well, we're seeing, Europe has gone to negative policy rates. So let me make a distinction here. When the Federal Reserve adjusts interest rates, we're adjusting what's called the federal funds rate, which is an overnight interest rate that banks lend to each other. The reason we do that is because it's a tool that we have, and that sometimes can signal about the future path of the economy. But you and I, as let's say homeowners, or you as business leaders, you don't really care about overnight rates. You care about interest rates over the next 5 years, the next 10 years. If your company is going to go build a factory, you care about interest rates for the next decade while you pay back the loan on that factory. So long-term interest rates, the Fed has some influence on, but not direct control over. So as we move these short-term interest rates up and down, long-term interest rates sometimes follow our lead, but sometimes they do their own thing. So a lot of long-term interest rates for governments around the world right now are negative. This is this inverted yield curve. That's because investors are bearish about the future. They're nervous about what the future holds. So the gentleman asked a question. It's a complicated question. If we were to lower interest rates, short-term rates to zero, that might flatten the yield curve. The yield curve could still be inverted if long-term rates were negative, as they are, let's say, in Europe. So it's a complicated issue of, it's not just where are rates, also is what is the shape of the yield curve. Because again, I'm getting technical here, but banks tend to borrow short from your deposits and lend long. So if they're losing money on that trade because they're borrowing at zero and lending at a negative rate, then lending money is not a profitable activity for banks. And then that can have a follow-on effect of slowing down the economy. So what the interest rate profile is and how it affects the economy is actually very complicated, and it depends on not just where rates are, but the shape of the yield curve and the liabilities of the banking sector, et cetera. So I apologize for giving you an incomplete answer. It's just a very complicated question that you asked, and I don't have all the facts to answer it at this moment.
Let me follow up with just something, I believe I remember this right, that I saw that in Denmark now one can acquire a negative rate mortgage. About like 0.5%, but it's negative. When negative rates would come into those kinds of markets, has there been a discussion of this within the Minneapolis Fed, at the FOMC? Are we thinking about what that might look like, so that we're not talking about policy rates, but we're now actually talking about them spilling into mortgage markets and other asset markets?
I mean, we debate this a lot with my staff at Minneapolis. We look at what's happening around the world, what's the experience. I mean, one of the really bad scenarios is if we were to follow the path of Japan. Japan has basically been stuck in a very low growth mode, essentially interest rates around zero for a long time, and they can't seem to get out of it. Now, I'm a little more optimistic about our future, because while our birth rate has fallen, theirs has fallen much more than ours have. And my view is I think Japan, in a sense, is trying to use monetary policy to solve for a fertility problem. And monetary policy, you know, it's a poor solution to a trade war. It's a really poor solution to a fertility problem. So I'm more optimistic about America's future, but we do look at experiences in advanced economies around the world to see what challenges they're having, how well their policies are working or not working, and what we can learn from them.
So a new father who's a monetary policy maker says monetary policy doesn't solve fertility. Got it. Okay. Next question, please. We have somebody up front, if you would. Oh, okay, right there then.
Given the global economy, how much cooperation is there between the central banks and around the globe?
I think there's very good dialogue. I mean, this is driven by Washington, and the New York Fed participate in many of these central bank forums. I think there's a lot of sharing of ideas and sharing of information. We have swap lines where we can lend money to other advanced economy central banks that started out during the crisis. That's been continued. So I think the cooperation amongst the professional central bankers around the world is very good.
There's a question in the back.
Yes, my name is Lee Bailey. I'm just curious. So I would assume, already have a fairly stimulus as it relates to fiscal policy with the level of the deficit that we have, and we have low interest rates. What are your thoughts about a rising deficit if we have to, or if we're able to agree on more stimulus from a fiscal policy standpoint?
Well, it's long run, I think there's no question that we have fiscal challenges in our country. If you just forecast, you know, most of our entitlement programs, Social Security, Medicare, Medicaid, these types of programs are funded by current workers paying for current retirees. And as our society ages, that ratio doesn't work anymore. And so you forecast the deficit over the next 50 years, it just skyrockets. So we have to somehow find the political will to make choices and adjust that. And those choices could be tax increases or benefit cuts or some combination of those things. That's undeniable. Now, the question is in the short run. We do have a lot of debt relative to history, but the US government is also borrowing at record low rates. You know, the 10-year treasury is whatever, 1.4, 1.5 today. That's very low rates. So that means investors around the world still think the US is a good place to put their money, are still very willing to lend money to the US government. So if there were a downturn, and if there was political will, let's say, for example, to do, I'm making it up, $1 trillion infrastructure package to go rebuild the US infrastructure, I don't think there's any doubt that the US bond market could accommodate that with no trouble whatsoever. Now, the challenge is, at some point, the check is going to come due. At some point, we have to get our fiscal house in order. But right now, all of the indicators are we have a lot of fiscal capacity.
Next question. Do we have one back there? Or I see hands. What? Oh, is there one over here? I didn't see. Is there? Oh,
there's a woman here.
So I have one back here, and then we'll come right to you. Okay, thank you. Yep. No, you're up.
I was just curious how the transition away from the LIBOR rate impacts your calculus.
Well, I don't think that it does. I mean, we're paying attention to it. Our economists monitor it. We look at a number of different interest rates in the money markets and in short-term funding markets to understand, is monetary policy propagating throughout the economy? So it's not something that's active in my deliberations because it seems like things are going okay. I'm just curious. I know we took the microphone away from you. Do you have a view? Sounds like there's a view behind that question.
Okay. No.
Just from the standpoint of how it will affect mortgages, mortgage rates, and you're talking about overnight rates, and we're moving away from a rate with tenors to trying to find a substitute rate. So just kind of how that crashes against what you're doing in setting
overnight rates. Yeah. Well, yeah, thanks. I appreciate the additional. I mean, we look at a lot of different rates to understand how is monetary policy propagating throughout the economy. Is it affecting the mortgage market? You would expect it to. Is it somehow bleeding away? So I think we have a team of economists that look at all of these different rates and then report to us how well is monetary policy propagating. So far, it's not been high on my radar as a concern, but we do have people who are focusing on the technical implementation details. Thank you.
I'm Retha King, longtime resident of the community. I'll leave it at that. And now having served on a number of corporate boards, and my familiarity with their work in domestic disaster relief assistance, and my background on how the Fed has come to the rescue of local banks when their banks were forced to close because of disasters, like Hurricane Katrina is a good example. Do you get involved in that kind of work by the Fed, which gets to be ever so critical when you have one of those major disasters in communities like now we are seeing in the Bahamas? Do you get briefings on what maybe the Atlanta Fed is doing or some of the other feds, or is that just small stuff?
No, it's not small stuff. It's important. And many of the, when there's, fortunately, you know, knock on wood, since I've been president of Minneapolis Fed, we've not had a disaster in our region. But my colleague, Rob Kaplan, president of the Dallas Fed, when there was major flooding in Texas, would report on, hey, this is what we're seeing in the Texas community. Here's the role that the Dallas Fed is playing. Former New York Fed President Bill Dudley, Puerto Rico is under the New York Fed's jurisdiction. So when the hurricane hit Puerto Rico, the New York Fed was very involved in trying to make sure that the banks were functioning and that there was cash available to the people in Puerto Rico. And I know in the Minneapolis Fed, there was major flooding in Grand Forks 20 years ago or so, and the Minneapolis Fed was very involved with their business leaders there and their local leaders there to try to do, they asked us for economic analysis on what the impact is to their region. I'm told that they then took that economic analysis and went to Washington and said, here's the economic impact that this is having in our region, here's the help that we need. So I think each of the 12 reserve banks and the Board of Governors looks for how we can play a constructive role, but it is done, as you indicated, on a regional basis.
There's a question all the way in the back.
Very good. Good afternoon.
Good afternoon.
I'm Todd Horsager, and thank you for your interesting insights this afternoon. I've got a question about the global impact of interest rates, in particular Europe in the negative interest rate environment and Japan in the negative interest rate environment, and the influence it's having on the U.S. interest rate complex. And you know, as a result, the 2-year and 10-year are hovering around 1.4, 1.5%, but like the Fed funds rate is targeted between 2 and 2.25 right now. How might that impact future Federal Reserve meetings and the short-term interest rate for the federal funds rate?
Well, it's something we look at a lot. You know, these major economies are connected, and if the rest of the world is slowing, if the rest, heaven forbid, if the rest of the world's in recession, it's very hard for the U.S. to just say we're going to be a strong, you know, we're going to sail through the storm unaffected. It probably will spill over onto our shores as well. So we look at all of these global interest rates. One thing that's really important, a concept that we spend a lot of time on, is what interest rate is neutral? What interest rate neither stimulates nor restrains the economy? We can't actually measure it directly, we can estimate it. And our best analysis says that over the past 30 or 40 years, that neutral interest rate has been gradually declining because of broader macroeconomic forces like demographics, like technology development. For a variety of reasons, there's a lot more savings of capital than there is demand for capital, and that leads interest rates to be low. So my best guesstimate is interest rates right now, remember I said typically the Federal Reserve would cut interest rates by about 5 percentage points? And today interest rates, as you said, are around 2%, the overnight rate. I think monetary policy in America today is moderately contractionary. So 2% is above neutral based on my estimate today. That's very different than 20 years ago, very different than 30 or 40 years ago, because neutral was much, much higher. So neutral rates, our guess is that neutral rates around the world have fallen quite dramatically because of demographics, because of technology, productivity, et cetera. And so what's happening around the world absolutely does affect us, and we pay a lot of attention to it.
Let me ask a follow-up to that, Neel. There's been discussion about, and you've talked about the communication strategy for the Fed and the FOMC. One of them is the dot plot, the very famous graph that shows the opinions of the FOMC members, including the non-voting members. Those are the presidents who don't have a vote that particular year. And it says to us basically what are they thinking in terms of where inflation's going, where unemployment's going, and it says where they think interest rates are going. One proposal I hear about that is identifying the dots, putting a name next to each one. So you've just said that you think that the long run or the neutral rate is somewhere below 2%. Okay, rather than ask you, so what do you think it is? I'm wondering if you might be amenable to the idea that you might put your name next to the dot that's on the graph.
You know, so the dot plot, one of the ways monetary policy affects the economy is through something called forward guidance, where if we tell you, I'll give you an example. If we said, hypothetically, we're going to keep rates at 0 for the next 10 years, and you can stick to it, we're really going to do it, that would probably drive long rates down a lot, because people have a lot of confidence that, well, rates are going to be 0, they're going to be 0 for the next 10 years. The stronger we can give these types of guidance and commitment, the more influence we can have on long-term rates. One of the ways during the crisis the Fed tried to influence long-term rates was by this thing called forward guidance. One of the ways of delivering forward guidance is this thing called the dot plot that King just talked about, where we predict, here's what we think is going to happen under ideal conditions. But the thing is, once you start going down this path, it ends up being very complicated, and economic conditions can change, and then all of a sudden you're continuing to put out this forecast. I mean, the dot plot has been much more wrong than it has been right, with the benefit of hindsight.
I agree.
And so the question I'm asking is, well, why do we want to keep doing something that's usually wrong, right? Maybe we should step back and ask ourselves, do we want to do this at all? So I'm probably in a different camp. Rather than adding to the dot plot, I'm kind of in the camp of maybe we ought to walk this thing back, because it didn't end up being as effective as we thought it would. Sometimes you don't know, and sometimes you have to experiment. The Fed did a lot of experimenting in 2008. To its great credit, not all of those experiments were, positive.
I've heard you say something similar to this at one time in the past about the amount of communication that happens regarding the Fed. Is it possible to over-communicate?
Sure. I mean, people often complain because you have up to 7 governors in Washington and 12 Reserve Bank presidents. That's 19 talking heads out there giving different messages. On one hand, it can lead to great confusion. On the other hand, it's part of the democratic process. It's the reason we have 12 independent Federal Reserve Banks. And I would argue that having different voices means we're going to make better decisions. I think when people complain about Fed communications, they're really complaining about the fact that we don't have perfect foresight into how the economy is going to evolve, and they wish we did. Darn it, why don't you just tell us what you're going to do over the next 5 years? It would make your lives a lot easier. I agree, if we only knew. And so I think the fact that this communication can be confusing reflects the reality that we don't actually know how the economy is going to evolve.
Great. Okay, I see some questions here. Is there a microphone? Wait, where's the microphone next? Okay. All right, we'll work it around to you. Don't worry.
Bob Marzak, an independent director. Again, thanks for being here. And I'm hoping you can educate me on the relationship between tariffs and inflation. I constantly read in the financial press how tariffs are hurting the consumer. I think Fortune magazine recently said it costs $654 a year for a family. Yet all of the consumer companies, Target, Costco, Walmart, record strong profitability, and inflation's very low. I don't understand how it could be costing us so much, but inflation can be so low.
Well, typically we think of a tariff as doing a one-time resetting of prices, that it wouldn't necessarily lead to long-term inflation increase. It would just change prices for consumers, and that would affect spending. But you're right. I mean, right now, the best source of strength in the U.S. economy right now has been the U.S. consumer. And to me, I look at that because the job market continues to be strong. Wages are climbing. They're not climbing really fast, but they are climbing. Families generally are doing better. They're having to spend money, put food on the table, buy clothes, et cetera. That's been good for the economy. I think the biggest way that I think tariffs hurt the U.S. economy is by creating uncertainty. I think if all of your businesses knew tariffs were going to be X%, if it's 10%, 20%, 50%, but they're going to be there for the foreseeable future, you would all adjust your businesses to accommodate that reality, and that wouldn't necessarily be inflationary over the long term. There would just be a one-time price level adjustment and economic adjustment. So I don't see tariffs as leading to high inflation well into the future. I think the uncertainty around tariffs is where the real cost is in the economy.
Question in the back. and then we'll come to you next.
My name is Zach Egan. I'm a international equity manager. Just a question about quantitative easing. When you look back over the last 10 years, how do you assess the impact of quantitative easing on the 10-year bond? Is there a way to measure what that is, or how has the Fed tried to measure that?
Yeah, it's a good question. It's a tough question. There are many different models have been designed by Fed economists and outside economists to look at whether or not how much effect did quantitative easing have. Again, the point of quantitative easing was once the Fed took the policy rate, the overnight rate, to zero, the question is how else can you affect long-term rates? So the Fed started buying up these long-term bonds to try to drive down long-term mortgage rates and treasury rates. One way they look at it is the adjustment in yields in response to a surprise announcement of quantitative easing. You can see yields adjust at that. And that's one way of saying, okay, X billion dollars quantitative easing led to 10 or 100 basis point adjustment of the 10-year. Question then is that sustained over time, or are those benefits, do they bleed off over time? So that's one way of doing it. Another way are more theoretical models looking at the term premium. You know, why are long bonds tend to trade at a higher yield than short-term bonds, and taking out, you know, both on a stock basis and flow basis. There are theoretical models trying to assess it. The honest answer is we don't know for sure how much effect quantitative easing ended up having on long-term rates. I believe it did have some effect. I don't believe it had as much effect as we would have liked. I don't believe the effects were as persistent as we would have liked. But once we were out of ammunition on the policy rate, we had to try to do something. And I think the downside of quantitative easing, the people who are against this said this is going to lead to runaway inflation and this is going to destroy the dollar. One thing we know for certain, they were dead wrong. So while the benefits may have been more modest than we hoped, the costs did not materialize. And that tells me overall it was a positive thing to do.
Hi, George Boyages with Cresso. We're a commercial real estate firm. Thank you for your remarks today. You've talked about your preference for strengthening the capital requirements for U.S. banks. If you could maybe talk about that in the context of conversations that the Fed has with other central banks around the globe, and the impact that the other central banks might do for other banks that are located outside of the U.S. and that cross-border implication.
Sure. I mean, that's one of the criticisms that I get from big banks in America is they say, if you raise our capital requirements, but if European banks don't do it, they're going to win out and they're going to take market share. And I say, let them. You know, I'll give you an example. I'm not going to name his name. We have, you know, Jackson Hole is this annual central bank conference that the Kansas City Fed hosts. It just happened a couple weeks ago. And one of the things that's nice about that conference is you have central bank governors from around the world who participate, and you get to meet with them and chat with them, et cetera. And there's a very prominent European central bank governor who I've chatted with many times, and he says, you know, all the regulations we put in place, these are the right things, these are great. And I said, do you really think that they've eliminated the risk of bailouts? He said, oh no, in Europe we understand every 30 or 40 years we have to bail out our banks. And the people are good with that, that's fine. We have the right regulatory system to achieve that goal. We have the same regulatory system here in America, folks. Don't we owe it to the public to tell them that, you know what, every 30 or 40 years we're going to have to bail out the banks? So I think that what's happening around the world is important, but I think their political systems and their expectations of their population are different than here in America. I think if we told the American people, by the way, I've been saying this as loud as I can for the last 3.5 years, if we told the American people we're going to have to bail out the banks in the future, that's the system we've come up with, I don't think they'd be very satisfied with that response.
The Minneapolis Fed has long supported research into too big to fail. And could you talk about where you are with that right now and sort of the directions the Minneapolis Fed is going with that research?
That's right. So for decades, the Minneapolis Fed has done a lot of leading work on this area of big bank failures. When I joined, I said, let's renew that work. Let's examine what's been done since the crisis. Let's examine if it's enough or if we need to do more. So in 2017, we put out our formal plan. We call it the Minneapolis Plan, which is trying to address too big to fail. And a hallmark of it is substantially increasing the capital requirements on the biggest banks. Unfortunately, right now, the political winds are such that the winds are blowing in a deregulatory direction. So we're moving in the wrong direction rather than making the banks safer, we're making them less safe. Again, we live in a democratic country. It's a democratic process. At the end of the day, the people need to decide what they want to do. All we can do is try to arm them with the best information possible.
I have maybe room for 2 more questions, and I have a couple fun questions for us to end on. So is there one in the back?
There's a mic here, this gentleman in the front.
I know he's waiting.
Okay.
I'm going to check in the back. If there's not one in the back, because I see our host is still holding the mic, so I'll go to you.
Thank you. Trey Whipple, I work with Merrill Lynch. You comment about banks being in a better financial position, than pre-crisis. I'm curious about the Fed's view on the shadow banking industry and their involvement and how they've really stepped in and provided capital, and therefore maybe the underestimated leverage that truly is in the system, but not coming from the big banks, but the shadow banking, whether it be BDCs and other type vehicles.
So it's something we pay a lot of attention to. We have a group in Washington, D.C., Financial Stability Division of the Board of Governors, and their staff of economists spend all day trying to look at different market segments to figure out where are the hidden risks. But we have imperfect information into many of the shadow banks that you're talking about. So it's something we pay attention to. We think the risks are somewhat elevated. We're not seeing flashing red that there's an immediate crisis brewing. But again, we have less visibility into it. If you go back to the Minneapolis Fed's plan for too big to fail, one part of our plan is to address the shadow banking risk. Because one of the criticisms of our plan is if we raise capital requirements on the big banks, then the shadow banks will just take all the activity. And if all the activity moves from big bank X to big hedge fund, is the system any safer? That's a good question. So our plan actually imposes a tax on the debt financing of large shadow banks to equalize the cost of funding, so there's no incentive to migrate the activity to the shadows. So it's something we're paying attention to. Personally, I think if the activity moves to hundreds of BDCs, that's better than moving to one giant hedge fund, because they're hopefully going to be taking less correlated risk, but you never know. But it's something we pay attention to.
Is there one more question in the back? Well, no. If not, let's have a little bit. Let's get one that's a little more serious, and we'll have some fun at the end here. Your first task at Goldman Sachs after you left graduate school was to research the IT sector, and eventually led to their whole IT security practice. Can you name one thing about IT today that excites you?
Well, excite is a concern. How about that?
Okay,
cyber,
you go there.
Cyber. It's the Federal Reserve spends a lot of money. We have a lot of IT professionals. We worry about the cyber risks of the banks that we supervise. We worry about our own cyber risk. And I'm sure all of you as corporate directors worry about this too. And you can never say we're good. You can never check the box. You can never say we're green in cyber. And so it's something that we are just constantly focused on, and we never know if we're doing enough. But for the nation's economy hangs in the balance. So there's probably nothing else that we take more seriously than trying to protect the cybersecurity of the Federal Reserve System.
Your Twitter feed would tell me that you're currently on a Civil War book kick lately, and that you just finished a biography of General George Meade, not the person that most people would be reading about at first, about Civil War. What's a book we would find on your bookshelf right now that would be a surprise to your general audience?
I don't know if this is a surprise because it's continuing the same trend. But right now I'm reading, there's a new epic biography that won the Pulitzer Prize of Frederick Douglass, which is phenomenal. I mean, it's an extraordinary book, extraordinary man. I'd already read one of his autobiographies, which was just so illuminating. And let me just tell you, if you want to go learn about somebody and get impressed, go read about Frederick Douglass. So this guy taught himself to read and write. Like if you read his writings, this is genius. This is Einstein kind of genius. This is Beethoven kind of genius. For somebody to be self-taught to read and write and to be so unbelievably eloquent, it's awesome. So, I mean, you don't have to invest in the 1,000-page Pulitzer Prize reading book. Just pick up one of his autobiographies. They're a short read, and you'll be blown away.
Thank you for that. Look around, make sure there's no more questions from the audience, so I will just, this one's more fun. I discovered you were a heavy metal fan, at least when you were in high school. Particularly, you seem to like AC/DC, and your high school yearbook quotes Rush, the band, not the radio talker. Okay. If I was to look at your cell phone right now and look at what music you've been listening to lately, what would I find?
Lately, I mean, mostly what I listen to is Motown, But lately, I've gotten into Fleetwood Mac, which is, I don't know how I stumbled upon it recently, but I wasn't into it when I was a kid, but I've gotten more into Fleetwood Mac lately. It'll change. 6 months from now, it'll be something different.
Okay, and the last question, everybody's, oh, is there a question back here? We'll get your question first, and then I will conclude with one more.
This one's on Beatrix, Doug Kuplik again.
On what?
Do you expect full adoption, or do you expect revoting? And what impact on the U.S. in the short and long run do you expect?
I didn't hear the question. First.
It's about Beatrix, and do you expect that there'll be full adoption?
Oh,
Beatrix,
Brexit.
or revoting? And what is the impact on the U.S. in the short run and long term?
Yeah, I don't know what the outcome of Brexit is going to be. The UK is a really important country in the global economy. It will have implications for the U.S. economy, but your guess is as good as mine as how the political system in Europe and in the UK handles it.
Looks like there's a quick question here, and then we're going to cut out.
Yeah, hi, I'm Cynthia Arnold. I'm a scientist as well as an independent board member, so a little bit twist on the questions. How have your tools changed in terms of analysis? But the economy is just one big multivariate analysis for you. So how have you changed and evolved to, say, bring in AI or machine learning and work with the data? Because you're surely not, as you introduced it, a bunch of guys sitting in a dark room and making decisions without really having sophisticated tools. So could you describe that a bit?
Well, first of all, I think it has changed a lot over the last 30 years. Or 40 years. When I go back and I read history of how central bankers 30 or 40 years ago, what they looked at, the data we looked at is very different than it was 30 or 40 years ago. There are different pockets of research across the Federal Reserve system. The Federal Reserve hires more PhD economists than any organization in the world. And we have people working on big data. We have people working with consumer companies to look at maybe we can scrape the internet to try to get a better sense of what's happening to prices, to try to measure inflation better. So there's constant innovation going on. People are testing out different models all the time. That's what makes it fun. I mean, economics is part science, it's part mass psychology. Like if everybody believes a recession is going to happen, there's a really good chance a recession is going to happen because we're all going to pull back. And so trying to look at the psychological aspects versus the science aspects with these very imperfect models. I mean, one of the things that I talked about, the neutral interest rate, that's a fairly recent concept. 20, 30 years ago, they weren't really focused on that. The pioneering work was done in the last 10 or 15 years. It's totally relevant to what we're doing today. So I think it's a constantly evolving, constantly changing, testing new tools all the time. And that's what makes it interesting and intellectually stimulating.
And so I'm going to test your forecasting. There's no multivariate analysis allowed in this particular question. He grew up in Ohio, so as you might guess, he's a fan of the Cleveland Browns in
I'm loyal.
Professional football. He's still loyal. So when the Vikings and the Browns meet in the Super Bowl next February, what's your forecast of the final score?
Final score will be 6-3. Your guess is as good as mine.
Very well played. Thank you so much.
Thank you very much.